Welcome back. Today, we are looking at a fascinating paradox playing out in the stock market right now. It is a story of two earnings reports, two falling stock prices, but two completely different underlying realities. On one hand, we have a semiconductor giant powering the global artificial intelligence boom, posting record-breaking numbers. On the other hand, we have the king of streaming hitting a new 52-week low. The market is sending a very clear, almost ruthless signal right now. It shows us exactly what investors are willing to tolerate and what they will punish without hesitation.
It really is a tale of two extremes. If you look at the raw numbers from this week, the contrast is stark. We saw Taiwan Semiconductor Manufacturing Company, or TSMC, post a massive 77% year-over-year profit surge. They beat revenue expectations and even raised their full-year growth outlook to over 40%, yet the stock dropped over 7%. Meanwhile, Netflix met earnings per share expectations but missed revenue by just a fraction of a percent, paired with weak forward guidance. The market absolutely hammered them, sending the stock down over 9% in a single day to a new low. It raises a major question. Why does a company with record-breaking growth get sold off alongside a company that is clearly stalling?
That is the core puzzle we want to unpack. Let us start with TSMC. When a company reports a 77% jump in net profit, hitting $22 billion for the quarter, and beats revenue consensus by over 7%, you expect a victory lap. Instead, investors focused heavily on their capital expenditure plans. TSMC raised its capital spending guidance to a massive range of $60 billion to $64 billion. That is up significantly from their previous projection of $52 to $56 billion. From a professional market perspective, this looks like short-term anxiety over margin pressure. The market seems to be saying, we love the growth, but we are worried about how much it costs to build it.
Exactly. But if we look past that immediate knee-jerk reaction, there is a deeper fundamental reality. TSMC is building the infrastructure for the next decade of technology. Developing 2-nanometer and 3-nanometer chip capacity requires massive upfront capital. This is not wasteful spending. It is an aggressive move to secure absolute dominance. In the semiconductor space, if you do not spend on capacity today, you lose the market tomorrow. The analyst consensus reflects this, showing a target price of $571, which represents a 42% upside. The market is temporarily punishing them for investing in their own future, even though that very investment is what guarantees their long-term moat.
It seems like a classic case of short-term market noise versus long-term value. Now, let us contrast that with Netflix. Their story is very different. They brought in $12.56 billion in revenue, which was a tiny miss against the $12.59 billion expected. Their earnings per share met expectations at 79 cents, and their operating margin held steady at 33%. But the real damage came from their outlook. Their revenue growth is decelerating from 16% down to 13%, and the forward guidance suggests the slowdown could continue.
That deceleration is the key word. Netflix is a mature business in a highly saturated market. The boost they got from the password-sharing crackdown is starting to fade, and subscriber growth in their primary markets is reaching a natural peak. Unlike TSMC, where high spending is building future capacity, Netflix's slowdown suggests their current growth engine is running out of steam. They desperately need a new catalyst, whether that is scaling up their ad-supported tier, expanding into gaming, or locking down live sports. Without a clear new growth narrative, that 60% analyst upside target of $108 starts to look like a value trap.
Let us look at the technical setups for both of these stocks to see how the charts align with these fundamentals. If we look at the moving averages, TSMC is currently trading around $401. That puts it below its 20-day and 50-day moving averages, indicating short-term weakness. However, it remains comfortably above its 200-day moving average of $350. The long-term uptrend is still very much intact. What are you seeing on the technical side for Netflix?
Netflix is in a much more difficult position structurally. It is trading at $67.58, which is well below its 50-day average of $80.94, and its 200-day average of $93.99. It is in a confirmed downtrend, hitting new 52-week lows with high selling volume. From a technical standpoint, this is institutional distribution. TSMC is experiencing a healthy pullback within a long-term bull market, while Netflix is searching for a bottom with no immediate support in sight.
So, if we translate this into actionable ideas for swing traders and active investors, how should they approach these two setups? Let us start with the short-term swing trade potential for TSMC.
TSMC is presenting a highly compelling swing trade setup. Right now, its Daily Relative Strength Index, or RSI, is down near 39, and the stochastic oscillator is at 11.5. These are deeply oversold levels. The price has actually broken below the lower Bollinger Band, which suggests a high probability of a mean reversion bounce. Additionally, the weekly trend remains bullish. For a swing trade over a 5 to 15-day horizon, we want to look at accumulating shares on weakness.
Let us get specific on the trade parameters for those looking to manage risk carefully here. Where are the key levels?
The optimal entry zone for a swing trade is between $385 and $395, with a limit order set right at $390. To protect capital, a stop loss should be placed at $375, which represents a risk of about 3.8%. The first target for this bounce is $420 near the 10-day moving average resistance, and the second target is $440 near the 20-day moving average. This setup offers a very attractive 3-to-1 to 5-to-1 reward-to-risk ratio. A daily close above $400 would confirm that the bounce has started.
And what about Netflix? Is there any viable swing trade setup there, or is it simply too risky?
For Netflix, the recommendation is to avoid it entirely. It is the classic definition of trying to catch a falling knife. Both the daily and weekly trends are bearish, and the massive volume on the sell-off shows that major funds are exiting. If someone absolutely insists on trading it, they must wait for at least 2 to 3 days of price consolidation to establish a temporary base. A potential support zone might form around $62 to $65, with a tight stop at $60, aiming for a minor bounce back to $73. But honestly, the risk-adjusted return just is not there.
That brings us to our strategic wrap-up and our call to action for our listeners. To summarize the market sentiment, we are seeing a clear divergence. The sentiment around TSMC is temporary overreaction to capital expenditure, which we view as a buying opportunity. The sentiment around Netflix is a fundamental concern about structural growth deceleration, making it a high-risk asset to avoid.
Professionally speaking, the core strategy here is to prioritize fundamental strength and market leadership. For TSMC, the fundamental analysis shows accelerating demand driven by artificial intelligence, making its massive capital expenditure a necessary step for future revenue. For Netflix, the strategy is capital preservation. Their slowing growth and lack of a near-term catalyst mean the stock is likely to underperform.
For our swing trade analysis, TSMC offers a high-conviction buy setup due to extreme oversold technical indicators and volume exhaustion on the sell-off, while Netflix remains a strict avoid.
If you are looking to start investing in TSMC, the recommendation is to accumulate on weakness. The ideal entry price point to start investing is in the $385 to $395 range. You should look to leave the market or take profits at our targets of $420 to $440 for a short-term trade, or hold for the consensus target of $571 over the medium term. To mitigate risk, you must leave the market and cut losses if the price breaks below the key support level of $375.
For Netflix, the recommendation is to stay on the sidelines. Do not start investing until the stock stabilizes and demonstrates a clear trend reversal above $60. If you currently hold the stock, consider reducing exposure, as a break below $60 would signal further downside. Keeping a close eye on these key technical levels is essential for protecting your capital in this volatile environment. Thank you for listening to the U.S. Stock Picker podcast channel.
The information provided here and on this channel is for general informational and for education purposes only. It does not constitute investment advice, financial advice, trading advice, or any other sort of advice. We make no recommendations regarding investment decisions based on this information. You are solely responsible for your investments. Please conduct your own research and consult qualified financial advisors before any investing. SEO Video Title: Why TSMC is a Buy and Netflix is a Trap, Tech Stock Predictions, and Growth Stock Picks, Stocks.Trade Podcast, Upside Potential Stocks, Pop stocks,